Good morning, good morning. Yeah, I hope everything's well. Got your cups of coffee, or you've had your cups of coffee, or maybe you're well into the day, depending on where you are in the world. Quick update from me. First of all, I wish everybody health and peace, and yeah, if you're going through tough times, patience and empathy as well. Um, so, focusing on my portfolio and some examples. So, right now, in general, I'd like to actually share with you what it's like to have a small company portfolio, particularly of high risk exploration or development companies where you have no firm revenue flows, and you're in a sort of a market where everything is just being sold down. And you may be, this year, myself in particular, the portfolio is kind of down 30-40% maybe compared to what it was at the beginning of the year, although 18 months ago it's had a good time. So overall, fair enough, but it's still in a good position. But compared to what it was, I mean, it's like this year is just tanked. I mean, with hindsight, if you had prior knowledge to sell your entire small cap portfolio and stick it into the Magnificent Seven or S&P 500, you'd have really had a really good ride and got it really right. But that's with hindsight. And my issue is I'm not a trader, I'm not a curve reader, although I'm learning as well. Yeah, and last week we discussed the La Sonde curve, and there are all other kind of trading strategies where that are being used by AI and used by other kind of investors, which benefit from or even drive these movements. But anyway, a portfolio that is suffering, so what to do? And I consistently just go to the companies, because I invest in companies, look at their prospects, what are they doing, are they meeting milestones, what are their NPVs, and if it's still looking good, then I'm really not following the stock price. I just like to bring an example of one company that I bought in, maybe it was about 18 months ago or something like that, very well-known one, called Latin Resources. And in that company as well, I remember I invested at around, I think it was 12 cents at the time or something like that, and because they were about to book an expanded resource by the end of the year or something, and I thought, okay, fantastic. So that all went ahead, everything happened, but what happened when the expanded resource was booked? The stock price was just sold down. So I see this selling into good news being used by everybody as a tactic, as a method. Now the problem with that is if everybody sells into good news, stock price is just gonna, laws of supply and demand, it's just going to tank, right? And that is what happened. But I was committed to the long term for this particular company, and this year it's been one of the stocks where at one point it actually ran to 40 cents. Even now it's around 25-ish. It's at a reasonably high valuation. We are now somewhere on the La Sonde curve, which I showed last week. The different stages of hype and bullishness versus risk loving versus risk aversion. And it's a company that's following in the footsteps of Sigma Lithium in Brazil, and there are some very similarities there, but it's fast tracking. So it depends on what your time frame is and how patient you are, and if you're great at riding curves. For example, with hindsight, one could have sold everything at 40 cents and then bought back at 25. Who knows? Is this going to stay at 25? Is it going to go to 20? I have no idea. But what I do know is economic studies, NPVs, discussions on offtake agreements, everything else, and a market which long-term prospects are fantastic. Okay, so that's the case study with Latin Resources, and I think it's applicable to many other investments. Now, in terms of the market that's driving a lot of these resource investments, in particular green energy investments, lithium and rare earths and graphite and what have you, the uptake of electric vehicles. Now, there's been a pretty fast uptake of electric vehicles, and I'd like to bring to your attention something called it's sometimes called the Gartner Hype Cycle Curve, or it's called the Gartner Technology Adoption Curve, where in the early stages of a technology, it's those sort of perhaps more high-end consumers that want the new tech, that drive the market. But then the market starts to saturate a little bit or flatten, and all of a sudden you get pundits sort of saying, oh, well, you know, that's it. We've flattened because of affordability and everything else. But that's the stage in the technology adoption curve where productivity and efficiency improvements come into play. So what we're going to see, and we are seeing, innovations and productivity efficiency improvements in the batteries, in the approach to production. I mean, you know, Elon Musk's pioneered Tesla, the casting approach to the production process. And you're seeing now, in particular, companies like BYD and Tesla are now developing and bringing online newer, more affordable, more efficient models. I may have mentioned previously, recently my wife bought a BYD Atto 3, and yeah, the cost and efficiency and just quality is fantastic. And I can see cars like that being adopted everywhere. So in other words, we're in a stage of efficiency and productivity improvement for the EV market, but it's going to continue to expand, which is good news for lithium. Hence, the long-term outlook for demand for cars is great. The long-term outlook for lithium is great. I think, but it's going to be a waiting game and investor sentiment. Right, final thing, going into sentiment, let's discuss interest rates, because frankly speaking, in higher risk investments, which give you not much income or zero income in early stages, the risk reward benefit for large investors, even for private investors, is driven by opportunity cost. So if you can stick your money in the bank 6%, or you're just feeling frightened, and you can get that kind of return, and funds can go for bonds, get that kind of return, you know, it really kind of balances things out. But as the interest rate cycle starts to kind of peter out, and potentially with inflation under control and then growth needing impetus, you start to get reductions. That really adds a catalyst and impetus, especially for the type of investments with zero revenue. It's sentiment. So that's the interest rate cycle. So that's just a quick summary of my current thinking on holding a small cap portfolio that has tanked this year, and I'd have done much better just by holding Microsoft or Apple or Google and having everything in it. But you know, that's no fun. I'm partly doing this because it's interesting. I'm allocating capital to companies that are involved in the energy transition, involved in change, with in some cases new processes, new tech, and that's fun. That's appealing to me. So no regrets. I made the choices with open eyes, and frankly speaking, if I just wanted to be easy, I'd just go for an S&P 500 ETF. I wouldn't even select Google or whatever. I just go, okay, let's just go S&P 500, follow it, close my eyes, and yeah, live happily ever after. Yeah, maybe. All right, look, have a great time. I hope you found this discussion useful. Thanks for the patience. Yeah, I'll try to cover some more companies. There've been some updates here and there. Tirana Resources, European Metals, there've been some updates there. Maybe we'll talk about those next time. But today, yeah, I used Latin Resources just as an example of where I've, in the past, held it, watched the price collapse, but it's gone up and the company's on a great trajectory. All right, thank you. Bye-bye.